silver plotted versus gold, again, which the one monetary metal versus the other is
Right.
vastly undervalued. Right now, silver is 1.6% of the price of an ounce
Wow.
of gold.
Yeah.
Well, if you look at 1980, it was 6.5% of the
Mm-hmm.
price of an ounce of gold. And you look at 2011, it was 3.1%. So, yes, silver's made new highs and blown through the old price archive, the old range, whatever kept it there. We understand there's arguments there why that occurred, but still it's vastly undervalued to gold.
Mm-hmm.
So all these things we look at from different angles all argue the same thing. This market hasn't even begun to correct its underpricing. Really is only several years old.
Mm-hmm.
And I think it's a concept that will probably be crushed into doubt.
Mm-hmm.
And I don't think the 60,000 low will ultimately hold.
Mm-hmm.
And I suspect the next rollover in Bitcoin will be fairly coordinated with the stock market rollover, which is to say, probably as we get into the third quarter. When I look at the Bloomberg Commodity Index, it broke out by our metrics to start a second major upwave in October of last year. Now, October of last year, it was crossing through 106.50, which was our trigger level on a monthly close. And it closed like that month above 107. So we got a breakout on momentum. Price was still below highs it had seen for the prior year around 108.9. But momentum said, no, you're gone. Okay. And what have we done since? And by the way, the surge in commodities, and Bloomberg's now in the 130, 140 zone.
Wow. Okay.
Versus where it was then at 106. So it's gained a good double-digit percent. Much of that occurred before oil even turned up. So everybody wants to say, oh, the commodity moves just oil. No, it's not. And the commodity asset category upturn from very cheap historic levels, even cheap compared to its own price history. Okay.
Right.
Cheap compared to the S&P, cheap compared to almost anything you want to throw a dart at.
Silver's current position relative to gold is not a buying opportunity. It is a structural anomaly that has appeared only twice in 4 decades, each time directly before a parabolic compression move. At 1.6% of gold's price today, silver sits at less than 1/4 of its 1,980 ratio of 6.5%, and less than half of its 2011 ratio of 3.1%. Michael Oliver has tracked momentum structures across every major commodity cycle since the 1970s. And what he is describing now maps precisely onto the copper breakout of late 2005, a range-bound market that moved quietly, then didn't.
What in the world's going on with silver?
Yeah.
And then we look at the spread charts, and this is a very important issue for us. What do I mean by that? Silver value to gold. Divide an ounce of silver into an ounce of gold, express the result as a percent, and go back, decades and plot that thing. And you'll notice that back in those two surges that occurred within the range, the $4 to $50, $4 to 50 range that prevailed, that in each of those explosive moves we saw, one in 1980, the other in 2011, there was a similar type of parabolic behavior by silver, which suddenly went from $5, $10 to 50. Okay. A lot of that was compressed in the final couple quarters of what had already been a multi-year advance. This time it's different in that you've broken out of a massive, bigger range. And we're going to put that in a report today. But just as an example, if you looked at an old copper chart, base metal, okay, go back to the 1970s, 80s, 90s, 2000, up to about 2005, copper lived in a range like a quiet little snake going sideways between
Very
50
boring.
cents a pound and $1.50, 50 cents, $1.50, for decades, okay?
Yeah.
And $1.50 was high, okay? It was the upper end of the range.
Yeah.
The average price for this decade was $1, okay? Suddenly in latter part of 2005, copper broke up out of that range Now, momentum foretold that it was going to break out of the range, but price also broke out in a way that any idiot with a price chart could say, ooh, copper made a new all-time high. But
Uh-huh.
it broke out of this massive range, and within several quarters, it was up to $4.10.
Mm, mm.
Well, and in the process of getting there, in other words, you quadrupled the price of copper, the
Right,
average price of
right.
the prior decades. Um, it only took a couple quarters, okay? But
Yeah.
in the middle of that, there was a, a violent period where, oh my God, it's topping. Okay.
Uh-huh.
It looked like, oh, that's it. It's over. Had you run. And admittedly, when you look at an arithmetic or a dollar-based chart of copper at that point, and its history, you say, my gosh, that's off the page. Would be 60,000. We did this back in November. Oil was slipping down through the 120, 110. You got down into about 110, and we hit one of our trigger levels. And at 102, we hit our final trigger level, 102,000.
Mm-hmm.
Sell breakage level, in other words. And we crashed.
Mm-hmm.
And where did we stop? $60,005 was the low. And I think, a couple months ago. And we said, okay, now it's time for a rally and congestion, but do not trust the rally or the congestion zone that comes after that low as a bottom.
Uh-huh.
Yeah, it's a relief. It's a pause, and it will cause people to want to come back in and say, oh
Yeah.
boy, it's good. Uh, I don't know where Bitcoin and the cryptos are going,
Mm-hmm.
but I don't think that was the low. And I think the low they could see would be such that the entire dream of what cryptos might be or are will be shattered.
Yeah. Yeah. The notion of a multi-million dollars
Yeah,
per,
like the
per,
other
per
money,
Bitcoin. Yeah.
the alternative money.
Yeah.
I think that 10-year dream, futures started in 2017,
Mm-hmm.
futures trading, late
Yeah, I
December
remember. Yeah.
2017. But that notion and the public-wide acceptance of the notion that it's
Yeah.
well below the break point, but not yet precipitously dropping, which I think is likely to occur. Is that a factor for gold? A bit.
Mm-hmm.
Frankly, gold is money, and it's not just money against the dollar,
Mm-hmm.
which is not money, it's government paper. It's also real money against the yen, the euro, all these unbacked fiat currencies.
Mm-hmm.
So, and if you try to correlate dollar index movement with gold, you
Mm-hmm.
really have a hard time.
Mm-hmm.
And the example would be if you take current price, 98, and you go back to 2015 when gold made its bottom at $1,050.
The copper precedent Oliver cites is not decoration, it is a structural blueprint. Copper traded in a $0.50 to $1.50 band for 3 decades, averaged $1, then broke that range in late 2005 and reached $4.10 within several quarters, a 4.1x move off the long-term average, compressed into less than 2 years. Silver's current breakout is structurally larger. It has exited a multi-decade $4 to $50 ceiling that held through 2 prior explosive moves, meaning the range being vacated is far wider and the reset target far higher. Bitcoin's $60,005 low, which Oliver flags as a relief pause and not a bottom, is the pressure valve releasing in the wrong direction. Capital does not move from broken narratives to new ones gradually. It moves fast, violent, and irreversibly. The Bloomberg Commodity Index crossed Oliver's trigger level of 106.5 on a monthly close in October of last year and has since reached the 131 to 140 zone, a confirmed second major upwave by momentum structure, not by opinion. Gold is not trading against the dollar. It is trading against every unbacked fiat currency simultaneously, which is why dollar index correlation has broken down and gold continues to make new highs in yen, euro, and sterling as well. Silver at 1.6% of gold's price is not a valuation footnote. It is the most compressed spread reading in 45 years of recorded data. And every prior instance of this compression resolved through a parabolic catch-up move, not a gradual one. The commodity asset class remains historically cheap against the S&P 500, against its own price history, and against virtually every comparable asset, which is the definition of a setup, not a trade. The real risk is not that Oliver's targets of $8,000 gold and $500 silver prove aggressive. The real risk is being fully allocated to US equities and dollar-denominated bonds when the bond market's bear signal, already confirmed, transmits to the equity market, and silver completes its ratio correction in a window measured in quarters, not years.